If you're watching this, you've probably got one big question. Should I run as a sole trader or set up a limited company? You're not here for theory, you just want a straight answer that makes sense for you without the headache. So here's what we'll do over the next 10 minutes. I'll show you the real difference, walk you through how the money actually flows, give you a quick 6-question test to help you decide, flag a few costly traps, and finish with a simple 30-day action plan for either path. And if you'd like me to double check your numbers, there's a link for a free 15-minute call down below. So let's jump in. Let's start simple. A sole trader means you are the business. Every pound you make, every risk you take, it all comes back to you personally. A limited company is different. It's its own legal body. Think of it like creating a separate box. Money goes into that box, the box pays tax, and then you decide how to take money out. Usually salary, dividends, or a mix. Now, the upside of being a limited company is protection. If the business runs into debt, the risk usually stops with the company, not your house or your car. The downside, however, is extra paperwork, higher running costs, and stricter rules. So at a high level, sole trader is simpler. Limited company gives you more protection and more options, but also more admin. Now let's talk about money, because this is where most people get stuck. As a sole trader, it's simple. Money comes in, you pay your costs, and the profit is yours. At the end of the tax year, you file a self-assessment and pay income tax and national insurance on the profit. With a limited company, it's a bit different. Money comes into the company, not you. The company pays its own costs, and then it pays corporation tax on the profit. Here's how that works in practice. If your profit is up to £50,000, tax is 19%. Now, if your profit is between £50,000 and £250,000, the amount in the middle is taxed at about 26.5%. And if your profit is over £250,000, the whole lot is taxed at 25%. What's left after corporation tax sits inside the company, and you choose how to take it out. That could be a small salary, it could be dividends, or it could be a mix of both. I need to point something out which is super important. If you run more than one company, HMRC calls them associated companies. That means your corporation tax band gets split. So instead of £50,000 at 19%, it might only be £25,000 at 19%. It's a detail most people miss, and it can bump up your tax bill faster than you think. The big difference is this. As a sole trader, tax hits you personally straight away. With a limited company, the company gets taxed first, and then you get taxed on what you take out. So let's pause for a second. Right now you might be thinking, okay, I get the difference, but which one should I actually pick? That's the key question. Let's make this practical. I'll give you 6 quick questions, answer them honestly, and by the end, you'll know if sole trader or a limited company is the best fit for you. Question 1. How much are you making? If you're making under 30 grand a year, sole trader often keeps life simple. If you're past 50, 60,000 pounds, a limited company usually starts to save you money. Question 2. Do you want protection? As a sole trader, if something goes wrong, it's on you personally. With a company, the risk usually stops with the business, not your house or your car. Question 3. Do you need credibility? Some clients, agencies, or even brand deals will only work with a limited company. If you need that trust factor, a company gives it to you. Question 4. Do you have other income? If you already earn a salary somewhere else, a company can help you manage tax more flexibly. If this is your only income, sole trader might be enough to start. Question 5. Are you planning to reinvest? If you're going to leave money in the business to grow, a company helps because profits left inside are taxed at a lower rate. If you're taking every penny out to live on, there's less advantage. And question 6. Do you want to bring in a partner or your spouse? With shares, a company lets you split profits and use both tax allowances. As a sole trader, everything comes under your name. That's the test. Just 6 questions. Your answer should give you a clear sense of which path makes more sense. So now you've got your answers. But here's the catch. Even if you picked the right structure on paper, most people still lose money because they fall into the same traps. And that's what I want to show you next, the common mistakes that cost creators thousands. So let's put some numbers to it. Say your profit is £60,000. As a sole trader, the first 12,570 is tax-free. The rest is taxed at 20%, then 40% once you pass the basic threshold. So your income tax is about £11,000. Don't forget national insurance, which will roughly come to £3,000. And what's left is around £46,000. As a limited company, the company earns the £60,000 profit. It pays corporation tax first, about £12,000. That leaves £48,000. You can take a small salary, then take the rest as dividends. Dividends are taxed at lower rates than income tax. And if you don't need to take out all the money out this year, you can leave some in the company or put it into a pension, both of which save you more tax. At £60,000, the savings is small, maybe a couple of thousands. But the higher your profit, the bigger the gap gets. Here's where most people slip up. They think choosing sole trader or limited company is the end of the decision. It's not. What really costs money are the details that follow. As a sole trader, people forget that national insurance kicks in earlier than they expect. They set money aside for tax, but not enough for national insurance, and suddenly they're short. And from April 2026, making tax digital starts for sole traders earning over £50,000. That means digital records and quarterly reporting, not just one tax return. And if you're still on spreadsheets, this is your wake-up call to get your system sorted now. As a limited company, the big trap is treating company money like personal money, taking cash out the wrong way, borrowing from the company. If your director's loan account is overdrawn and not cleared within 9 months, HMRC charges a temporary 33.75% tax. Many first-time directors fall straight into this. And then there's timing. If you pull all the profits out in one go, you can easily put yourself into a higher tax brand. Take it out bit by bit so you can keep more. And one more quick reality check, VAT. Whether you're a sole trader or a limited company, once you hit £90,000 in a rolling 12-month period, you must register. And don't forget, limited liability isn't absolute. If you signed a personal guarantee for a loan, or you've traded recklessly, your personal assets can still be on the line. These are small mistakes. They're the kind that can cost thousands over a few years. Alright, let's wrap this into something you can actually use. Here's a 30-day action plan, whichever way you go. If you're running as a sole trader, in week 1, register for self-assessments if you haven't already. In week 2, open a separate business bank account. It's better to separate your business and personal money. In week 3, set up a simple system to track income and expenses. Even a basic app will do. And in week 4, put aside at least 25% of everything you earn into a tax pot. That habit alone will save you stress later. This path works best if you're keeping things simple or under that 50k revenue mark. Once you're above that, it's worth revisiting the limited company options to see if you could save more. Now, if you're going limited, in week 1, form the company with Companies House. In week 2, open a business bank account in the company's name. In week 3, decide your mix of salary and dividends. And in week 4, set up bookkeeping software and get into the routine of recording every expense. And don't forget the little compliance jobs. Register for corporation tax with HMRC within 3 months of starting to trade. Register with PAYE before your first salary. File your confirmation statement each year and file your accounts on time. This path usually makes sense once you're earning more than £50,000 in revenue, reinvesting into your brand, or working with clients that expect you to be a company. Finally, think about pensions. If you're limited, company pension contributions are one of the most powerful ways to save tax. Follow that plan and you'll have a clean foundation in just a month. Now let's do a quick recap. Sole trader, simple, cheap to run, but less protection and less control over time in your tax. Limited company, more protection, more options, but more admin and cost. The choice usually comes down to 2 things: how much profit you're actually making and how much flexibility you want with your tax and cash flow. And remember, it's not just about the setup. The real savings come from how you manage it after. If you're still unsure which path is right for you, don't guess on this. Book a free 15-minute call below. If you're making over £50,000, it could save you thousands. Slots are limited, so grab one while you're here. That way, you leave here not just with information, but with a clear next step.